Hey everyone, welcome back to Corporate Decoder, the place where we turn financial filings into something you can actually understand. Today we're diving into a report so short, you might think there's nothing to see, but trust me, even a small document can hide some interesting details. We are looking at the PUTNAM Ultra Short Max Series semi-annual report. Basically, this is a fund that invests in very short-term debt, aiming to give investors a safe place to park their money while still earning some income. Let's see how they did in the last 6 months. The report starts by listing all the investments that the fund holds. It is basically a list of all the companies and governments they have lent money to. Most of it is in corporate bonds and notes, which are just IOUs from big companies, 79.7% of the total. Then they have some commercial paper, which is very short-term debt, at 16.2%. Asset-backed securities or loans bundled together make up 3.6%. And finally, a small portion at 0.5% is in US Treasury obligations, meaning debt from the US government itself. If we look at the kind of companies the fund invests in the most, we see that the majority, 43.6%, is in banking. This means they're lending a lot of money to big banks around the world, like Bank of America and Barclays. This is followed by consumer cyclicals such as car makers at 7.1% and insurance at 5.5%. The report also breaks down where these investments are located geographically. Most of it, 58.4%, is in the United States, followed by Canada at 7%, then Australia, the United Kingdom, the Netherlands, and so on. So they're not just investing in one country, they're spreading their money around to different economies. Now let's look at the financials. This is where it gets interesting. The fund had a total investment income of $743,087 in the last 6 months. Most of this was interest they earned from lending out their money. After subtracting expenses of $85, the fund made a net investment income of $743,555 to fund. Made a net investment income of $743,555. The fund also made some money by selling investments for a profit. They had a net realized gain of 6,262.35 ICEs and an increase in the value of their investments, also known as unrealized appreciation, of $17,332. All this adds up to a net gain on investments of $23,567. Ultimately, the fund's net assets increased by $766,622 from operations. But then they paid out $767,389 in distributions to shareholders. In addition, there was $70.92 increase from capital share transactions. Overall, this results in a total increase in net assets of $69,425. The fund started the period with $27,738,648,064. Next, we get a financial highlight, which shows the performance on a per share basis. The net asset value at the beginning of the period was $10.05 per share, and it ended at $10.05 per share. This means that even though the fund made some money, it was mostly offset by the distributions they paid out. The report also gives us some key ratios. The expense ratio, which is how much it costs to run the fund, was really low, close to zero. The portfolio turnover rate, which is how often they buy and sell investments, was 22%. The filing also goes into how the fund values its assets, which is based on a standard accounting practice. Most of the securities are classified as level 2, meaning they're valued based on market information, but not necessarily the exact price they were traded at. There were no changes in the accountants that were hired to oversee their financials. There were a few management-related changes that are described at the end of the report. Basically, one of their sub-advisors, PIL, merged into another company called FTIML. The trustees, the people who oversee the fund, had to approve this change. They considered all the factors and determined that it was in the best interest of the fund. Now let's zoom out and think about what this all means. Could this fund invest in very safe short-term debt? They didn't make a lot of money, but they also didn't lose any. In a world where interest rates are changing all the time, this fund is trying to be a safe harbor, a place where investors can keep their money without too much risk. They lend a lot of money to big banks and other large institutions, mostly in the United States, but also around the world. It is a low risk and low return strategy. One thing to note is that at the end of the reporting period, 30.1% of the outstanding shares of the fund were owned by an affiliate of Franklin Advisors, the fund's manager. This isn't necessarily bad, but it's something to keep in mind. This affiliate has a big stake in the fund, so their interests are closely tied to the fund's performance. Ultimately, the goal of a fund like this is to provide stability and a bit of income, and it looks like they're doing just that. It's not going to make you rich, but it's also not going to keep you up at night worrying about losing your shirt. Thanks for watching. If you found this helpful, please like, comment, and subscribe for more Corporate Decoder.